Traders, what's happening? Welcome back to my YouTube channel. So today's going to be a very special video. A lot of you are asking me to help share a limit order strategy with you. Now, I just want to say this, I am going to share a limit order strategy with you that I personally have used in the past, have worked on very hard worked very hard on it and spent a lot of time collecting data. The thing is, with the questions that I'm getting though, I'm starting to feel that a lot of you are jumping from one concept to the next and you're not allowing enough time to pass in order for you to get the true results of a single strategy. Now, we're 3 months into the year. In theory, you know, new year should have given you an opportunity to figure out what strategy you're going to be using, which one you're going to be applying, and really and truly, you should be sticking to it for at least 90 days solidly. And one of the biggest questions you must be asking yourself is, have I really committed 100% to it? If you haven't, don't switch concepts. But for those that are genuinely looking for a limit order strategy, I'm just going to give you a really brief overview of this concept. And I'm going to give you 4 examples of what you could expect from any strategy, period, whether it's a limit order strategy, a stop order strategy, an instant execution order strategy, whatever it may be. I'm going to share it with you today. I just want to say that if any of you are judging me because you're seeing the space in my shirt, I just want to let you know I'm losing a lot of weight, getting prepared for summer, baby. So yeah, we'll be getting on the tighter shirt soon again once I drop maybe a couple more pounds, but that's why we're a bit baggy over here. Anyway, let's focus on the strategy. All right, traders, so look, simple concept. It's the same concept as anything else we look for. We're looking for the market to create downtrends, we're looking for the market to create uptrends, and we're avoiding any market structures that are moving sideways, period. Now, the difference with looking for uptrends and downtrends is that not every single time will the market be trending for a long period of time to validate that that trend is trending down, or even to validate that that trend is trending up. So in some scenarios, you may find that the market decides to break out of consolidations to the upside or to the downside that will then start new trends. If this happens, then it is completely fine to look for trades within consolidations, but what you want to see the market do first is create those retests and then only look to take trades once you have an identified mark of price breaking a structural high, or you have the market breaking a structural low. Only at this point and this point do you want to be looking for trades. These two scenarios will then illustrate this scenario here, which is the downtrend or the uptrend if it's not trending as clearly as you want it to be trending. So the idea is this: once we identify that the market is trending down, you are simply looking to place a level where the market has previously broken the lower low or previously broken the higher high. Once you've identified this, you are now reverting back to simple break and retest theories, where you're looking for the market to pull back to a key level to retest. The difference here is this: you are not looking for any confirmation or evidence. You are simply just waiting for the market to pull back, to tap into that level, and then look to enter the market once price is tapped into it. You will be setting here, on this occasion, if you're looking for sells, a sell limit to look for a trade. If you are looking to take a buy, then you're simply waiting for price to break above structure, and then you're looking for price to come back to this key level again to then place a buy stop. Now, I'll go into a little bit more about this in a second, but this is just the simple concept that you all must understand. So here you can see we have our two scenarios. The one criteria that you must be very, very well aware of when looking to use this limit order strategy is that on the breakout, price must break out very strong to the downside or very strong to the upside. If it does not break out strong to the downside or to the upside, you want to avoid taking any trades or setting any limit orders. The reason for that is because the theory behind this concept is that higher time frames are doing one or two things. They are breaking strong above structure, indicating higher time frame bullish candles, or they are breaking strong below structure, indicating higher time frame candles. Once the breakout happens, what usually will happen on the higher time frames is the new candle that opens will retrace around 50% of the previous candle and at this stage create a wick. Once this wick is formed, then and only then will the market continue in this direction. Same for selling positions. If the market breaks strong to the downside, this is to the upside. So let's mark this, and this is to the downside. So same to the downside. If the market closes strong bearish, more often than not, price will pull back to 50% of that previous candle. It will then create a wick, and only after creating that wick will it then continue to the downside. Now at the stage of this candle, after a breakout to the upside, pulling down and creating that wick, that is where you want your buy limits to be set at 50% of the previous higher time frame candle, in anticipation that you'll be triggered in line with the lower time frame trends pushing up, and then see the market continue in your direction. The same with the sell limit. Once the market decides that it has broken a structural low, the higher time frame candles will more often than not pull back to 50%, which is your sell limit level, before then going in your direction as part of the lower time frame trends, which is down. That's a concept. You really want to be going for a 1 to 2 risk reward ratio in most instances, and your stop loss placement you want to be placing above the previous lower high or below the previous higher low. And that is as simple as it is. So let's take a look at a few examples and go over this. So the first example we're going to take a look at is USD JPY. We can clearly see that the structure of this market is now trending. We see high highs and higher lows being formed, and now we can see price creating a level where price is failing to break above. We now have a very strong break above this structure, and this is a break above we're looking for. A single candle strong break above really strong, or a few candles breaking really strong. But you don't want to see choppiness, you don't want to see indecision candles, bearish candles, then bullish candles. You want to see a strong movement up. This now highlights to us that the high time frame candles are strong, pushing strong bullish, and there's a very high chance price can pull back to the retest level to create that wick on the higher time frame before then deciding to continue pushing up. This is how you want to set your trade, going for a 1 to 2 risk reward ratio or whatever it may be, and then you want to take your trade. Stop loss below the previous higher low. In this instance, this is a very big wick, but what can we do? We have evidence here. We have strong bullish sentiment. The trend is up, the break is strong, and now we're just patiently waiting for the market to pull back to trigger us into the trade, which you can clearly see is here. And then once you're in this trade, you will either manage it to break even, win this trade, or lose this trade. And once this happens, you just wait patiently and see what the market does. Now, the reason why this would work is because the trend is up. The higher time frame candle previously closed bullish. That means the next candle should go bullish, and after an exhaustion phase, more often than not, the market will have a continuation phase. And that's a simple concept. Let's look at example number 2. Example number 2 is identical. We have a trend to the downside here. We have a much deeper pullback. But what we understand from basic price action, as long as price does not break the lower high that made the major low or a major key level, we're still sell bias. We identify a level in the market where price is failing to break below. So once we get a momentum shift, we understand there's a very high chance price will continue bearish. Once we have this evidence, we anticipate that after a push phase, a pullback will develop to create the exhaustion of this continuation move, and in anticipation that we'll come back to this retest level as a level in the market where it's an area of sensitivity, we could say, or an area where we know price is going to react. That's where we want to set our sell limit. We have everything that's in our favor, and we want to execute this trade and wait for price to pull back. As you can clearly see here, this is where our sell limit was triggered. Now, you would either win this trade, you'll break even this trade, or you will lose this trade. And from then, you just continue on the process. And as you can see, a very simple concept. Now, I don't just want to show you winning trades. I also want to show you the other scenarios that could play out with this concept. Let's take a look at example number 3. Example number 3 here is on pound USD. As you can clearly see, price has broken out of this consolidation. The market is overall trending. You can choose or make a decision how you anticipate this. But we can see it's a very strong push above structure. There's a lot to confirm that there's a bullish sentiment here, and there's a very high chance that price can pull back to retest the previous structure as part of this overall uptrend. We broke out the consolidation, we've broken back in, and we've broken structural highs. Now, again, I'm not here to teach you how to restructure or how to understand behavior. You should either be doing that already, or you'll just have to learn as you're going along. Now, the higher low in this instance, or the structural low, is way too far from me, so I don't want to put my stop loss all the way down here. I much prefer to put it below this candle. My thought process is that if price is going to continue up, we shouldn't break these lows, we should continue up, and I'll set my trade. Now, just as we've seen in the last two scenarios there, our two wins on our buy and sell, this is what also can happen when you go for sell stop or sell limit and buy limit entries. The market could just leave without you. Even when it pulls back, there's a very high chance that price will not come back to trigger you in this trade, as you can see here. Now, don't go away and think, oh, Rox has just taught me an amazing limit order strategy and everything should work perfectly. Please also understand that this will happen. At times, you may not get triggered into the trade. At times price will leave you, at times price will pull back but not come back to the entry that you anticipated to come back to. You have to learn to just get over it, move on and take another trade. It is what it is, it's life and it's part of trading. Let's take a look at our fourth and final example. So for our fourth and final example, we'll take a look at Euro New Zealand dollar. Now we can clearly see this doesn't really fall in line with our concept because we're not trading with a trend here, but you've identified euro strength. You can see prices breaking above the previous lower high that made the lower low. So that definitely can indicate to us that the markets are bullish. And what you say to yourself is at this stage, well, I just want to take this trade because I do believe if it comes back to this level, there's a very high chance that price will respect it, continue bullish. I don't really have a stop loss placement in mind because there's not a high low that's been formed yet, but I believe that if it trades above the key level, then we should continue bullish back to some of these highs. So you'll plan to take this trade slightly, a bit out of your plan, but you go for the trade and you just wait patiently. And if you really want to be a bit finicky here, you can be like, wow, this is an absolute amazing perfect entry and everything should work out in my favor. And then you continue to take the trade, and sometimes, just sometimes, this will happen. You'll get the most perfect entry and you'd also get the most perfect stop loss before then seeing price go in your direction. So I want you to understand, everybody, we've looked at four examples here. One on the 5-minute time frame, another on the 5-minute time frame, one on the hour time frame, and one on the 15-minute time frame. All you need is one time frame of your choice. Identify the trends, the structures, the key levels where you want your limit orders placed, and place your trades. Some will win, some will not get triggered, and some will lose. It is what it is. But you must go away, take 100 trades, try it out, see what happens, and then go from there. So I hope you found that useful, everybody. Again, this is a very powerful concept with a very high probability of, or high probable win rate. And I do believe that if you really apply yourselves to the best of your ability, you can make this work. But make sure that you backtest it. You're patient, you identify your levels that are broken. There's strong key levels that have been broken with strong breakouts. Then make sure that the markets are trending. Make sure you know where your stop loss should be placed above higher lows or lower highs, and then take your trades. Go for 1-to-1s, 1-to-2s, 1-to-3s, whatever you want. But first and foremost, go try it out, see what you think, and let me know in the comments what you think of this. So until next time, enjoy the concept, continue to trust the process, like, subscribe, turn on notifications, and until the next video, take care for now.